We need someone to buy the debt, right? The buyers of the debt are kind of deteriorating a little bit, or they're not as interested in buying our debt as they once were, right? So this is China's nominal holdings of U.S. Treasuries. China's the second largest holder of U.S. debt. I think we all know they're selling out of their position, whether they see it as a bad store of value or they don't want to be exposed to the capriciousness of U.S. foreign policy. They're selling down their position. Japan is the largest holder of U.S. Treasuries, and they're selling down their position, too, to defend the yen. So this is a bit of a theme. The large holders of U.S. Treasuries are selling down their debt. What does this do? This makes it more expensive for the U.S. government to finance their operations. Ultimately, if foreigners stop buying our debt, we're going to have to pay higher rates in order to induce people to hold our debt, which is just generally very expensive for the U.S. Our interest expense is already about $1 trillion, so it's a huge drag on the U.S. And so this is kind of the aggregate chart. This shows all foreign official holders of the federal debt. And it's actually been declining since 2014 pretty steadily, right? And the Treasury needs to find new buyers, right? So you probably figured out where this is going, right? Stablecoins are a significant, albeit still small, but very quickly growing buyer of U.S. Treasuries, right? So this is data I just put together. If you counted stablecoins as a sovereign nation, they're actually the 16th largest nation, so to speak, as far as holding U.S. debt is concerned. And the stablecoin sector, they hold around $120 billion of U.S. Treasuries. It's more than the Saudis, more than Germany, more than Mexico. It's pretty meaningful. And keep in mind, this is only over about 6 years. And stablecoins have only really existed as a thing since about 2018. So we went from pretty much zero to around 120 billion of U.S. debt instruments being held as a sector in about 6 years. So, still not among the very largest holders of treasuries, but growing rapidly. And I think we all think if the crypto industry keeps thriving and balance sheets keep growing in crypto, those tend to be stablecoin denominated. As we've seen, stablecoins tend to be very dollarized. It's a very free market, and liquidity seems to really dominate here. And so for now, it seems like stablecoins are a big buyer of U.S. debt and generally accretive and potentially in the future very useful to the U.S. government as far as a buyer of that debt holding down rates, which would be quite useful for the U.S. government. Now, in terms of what's happening here is stablecoins are pretty much going offshore. Obviously, Tether is the largest stablecoin by far. They're offshore. We don't know where exactly, but they're certainly not onshore. And I've listed out a bunch of other jurisdictions, a bunch of other projects. So these are all USD stablecoins or tokenized US Treasuries, which is growing significantly as a cohort. And these are being listed in all kinds of jurisdictions, increasingly outside of the US. A lot of these are interest-bearing. A lot of them are offered to retail. For that reason, it can't really be done in the US, right? The SEC has already considered some stablecoin securities, so you couldn't offer an interest-bearing stablecoin to US individuals. They're going offshore to do this. They're going to Bermuda, BVI, Germany, Singapore, Hong Kong, other places where regulators have shown an appetite and a willingness to host stablecoins and have been passing pro-stablecoin legislation, but acknowledging that these are mainly dollar stablecoins, right? So this is what is happening. There is a market for offshore dollars on a tokenized basis, offshore tokenized treasuries that are interest-bearing. And it's proliferating globally very rapidly, especially as these regulators signal that they're willing to host dollar stablecoins. You saw Singapore pass stablecoin regulations just this year, allowing for dollar stablecoins to be issued. Hong Kong just mentioned, I think yesterday, that they're going to be passing stablecoin regs next year. There's already a US stablecoin issued in Hong Kong, First Digital, which is growing pretty quickly. You see Bermuda just a week ago or 2 weeks ago licensed the first interest-bearing dollar stablecoin under their digital asset license. So this is happening. It's happening quickly. The problem is in the US, this year we've only seen provocation. We've only seen marginalization of the stablecoin sector in a really extreme way, right? In January, the Custodia application was denied. They didn't get their master account. They were going to try and issue a dollar stablecoin. In January also, the major financial regulators in this country went to banks and said, basically don't touch stablecoins. It's too risky. It's not compatible with safety and soundness. We don't want you doing stablecoins at all. The SEC came after Paxos in February. In March, we had the banking crisis in this country. Silvergate and Signature were basically taken out behind the woodshed and shot. And unfortunately, you can say they failed on their own or they were assassinated. I'm on the side of assassination. Unfortunately, they ran fiat clearing infrastructure, Signet and Sen, which allowed stablecoins to have liquidity outside of banking hours. And if you think about banking hours, there's more hours the banks are closed than they're open. So this was a significant blow to stablecoin liquidity. And recently in August, the Fed reiterated that they don't want banks touching stablecoins. Meanwhile, overseas, you have pro-stablecoin regs, you have pro-crypto regs, you have all these jurisdictions saying that they want to be a home for crypto. So we have harassment in the US, and we have an embrace abroad. It's quite tragic. So these are kind of the four main things the US did this year to marginalize the stablecoin sector. They didn't allow the sales or the acquisitions of Sen and Signet. Basically, they disallowed, the FDIC refused to sell Signet, even though they had a mandate to maximize the value of the signature assets. They refused to allow that to be sold, so they destroyed it. The Fed said that banks can't issue stables, they can't touch stables at all. We didn't get any stablecoin legislation. It's probably not going to pass the Senate. The Senate is hostile. And also in the US, you cannot issue interest-bearing products for retail, so you're not going to see interest-bearing stablecoins in the US. It's all pretty unfortunate. It was a serious attack, and the stablecoin space in the US is pretty troubled. So this is a chart just showing the supply of onshore versus offshore stablecoins. Before FTX, they were basically at parity. After FTX, things turned hostile in this country. You had the Silicon Valley Bank collapse, USDC depegged, massive outflows from USDC and other onshore stablecoins, massive inflows to offshore stablecoins as Operation Choke Point 2.0 kicked off, right? So you had an offshoring of balance sheets from the US to abroad. Also, interest rates are causing outflows, right? If you are a US entity and rates rise, you want to get a return on that capital. You're not really able to do that through a stablecoin that's non-interest bearing. So you saw the USDC supply contract significantly as rates rose there. So another thing that I'll mention before I get to the punchline here, you're seeing a new crop of stablecoins that are being issued against crypto collateral, right? Primarily against staked ETH, right? There's a variety of methods here, but the main thing to take away from this slide is stablecoins don't strictly, even if they're dollar stablecoins, they don't strictly have to be issued against US dollars or treasuries. There are creative and interesting ways to use staked Ether to contrive to build a synthetic dollar position, whether it's the over-collateralized model, the middle column here, or a synthetic model, a little bit more complex, the left column. So you're seeing crypto-backed stables emerging, and I think they're going to grow in their market share. So the last thing I'll say before we get to the point is most of the concerns from the government regarding stablecoins have been addressed at this point, right? Stables don't really impair your ability, if they're onshore stables, to project power, to engage in sanctions, because they have this freeze and seize functionality. The vast majority do. You can't seize dollars, physical cash at a distance. You can do that for stables. They're not really a threat to financial stability. We haven't seen that meaningfully. They're not really inconsistent with law enforcement needs. As we all know, the blockchain is a bad place to do crime. So they're not really that incompatible with law enforcement. And they don't necessarily eliminate the centrality of the US in financial markets. As we've seen, stables are very dollar-dominated. The major stable issuers are US-based. So basically, this is the answer to our question. Will they serve or subvert US interests? I don't have the answer because the answer is up to Washington. It's what they decide, right? They can choose to have the onshore paradigm of stables, or they can choose to have the offshore paradigm. They cannot choose to have stablecoins not exist. The market wants stablecoins, and the market mainly wants dollar stablecoins, right? If the US continues to harass the stablecoin sector, they will be issued offshore in all the jurisdictions I mentioned. They will likely be dollar stablecoins, but they will be outside the control and the aegis of the US government. So it is basically up to Washington, it's up to Congress, it's up to the Biden admin. If they choose the onshore paradigm, there's more demand for US treasuries. You have a brand new buyer of the debt, which we desperately need, given that everybody else is divesting. The US retains the ability to use those financial rails for power projection, for law enforcement purposes, and for sanctions making. They would still retain that ability. They would have influence over the issues of these stables, and you're spreading the US dollar and the property rights that come with the US dollar worldwide. The US would remain the global capital markets hub through stablecoins. Now, the counterfactual, the offshore paradigm, this is what is happening right now. You have stables being issued against crypto-native collateral as opposed to dollars. It's not necessarily accretive to the debt. It doesn't necessarily make our debt cheaper in that case. Other jurisdictions seize the opportunity. They become the major domiciles for stablecoins. This is happening. It's going to continue to happen. They're seeing the reticence of the US, and they're moving in aggressively. You may suffer that loss of sanctions-making ability because offshore stablecoins may not want to listen to the US government. You may not have influence over them. They're just not as accountable. And the US may well be marginalized as a capital markets hub. So ultimately, I can't answer this question. It is basically up to Washington. The choice is not stablecoins or no stablecoins. The choice is stablecoins where? Stablecoins here or stablecoins elsewhere? Accountable stablecoins or unaccountable stablecoins? That's the choice. I'll leave you with that today. I'll wrap it up there. Thank you very much.